joining us now is Phil Angelides, who, among his many accomplishments in politics and in the private sector, was and remains known for being the chairman of the Financial Crisis Inquiry Commission, which was impaneled after the financial crisis of 2008 by Congress to look into the origins of that crisis and determine what needed to be done in order to prevent such crises in the future. He joins us now. There are a couple of ways in which that report is once again in the news. So, Chairman Angelides, thanks so much for joining us.
Good to be with you.
Listen, I wanted to address a couple issues with you, but let's start with this. It's been about 5 years since the report came out. Let's start on the global level. Where do you think we've gone? Your mission was with the commission was to identify the causes of the crisis and ensure we don't experience another one. How far have we gotten in that?
Well, not as far as we need to get. Clearly, with the passage of the Dodd-Frank law, there have been some improvements in the system, more oversight over the biggest financial institutions, some new standards on mortgage lending to ensure that we didn't have the kind of meltdown in mortgage lending standards we had in the lead up to the crisis. More derivatives being traded in the open, brought out of the dark markets, but too much risk still in the system. I think in the biggest picture, the way to think about this is in the wake of the crisis, let me just say this. Normally, when we make grave errors, we learn from the consequences of our mistakes. Unfortunately, Wall Street, because of the massive bailout of the banks, and by the way, people focus on TARP, the $700 billion bailout, but there were some 24 different programs in which the taxpayers of the United States extended trillions of dollars of assistance to Wall Street to stabilize individual banks in the financial system so that the economy didn't completely crash. But in the wake of the crisis, in a sense, because Wall Street was saved from the consequences of its mistakes, there's been very little critical rethinking. And I think it's fair to say that Wall Street really paid no economic, legal, or political consequence for its misdeeds and has spent much of the last several years after the crisis fighting needed reforms. And therefore, here we are some 9 years after the onset of the crisis, some 7 years after the peak of the crisis, and we still have a set of too big to fail banks. In fact, a greater concentration of power in fewer banks than ever before. By 2011, the biggest 10 banks in this country controlled about 80% of the banking assets. These institutions are too big to fail, they're too big to regulate, they're too big to manage, and they're too big for our democracy. We haven't had any real reform of the credit rating agencies.
Yeah.
We still have major institutions taking very significant risks in the marketplace. While more derivatives are now traded in public, there's still dark markets not subject to regulators. And, of course, Wall Street and its allies continue to assault the budget of the key watchdogs, the Securities and Exchange Commission, the Commodities Future Trading Commission. So we're still, in my mind, not where we need to be.
Well, I listening to you, Chairman Angelides, one of the images that came to mind was the captain of the Exxon Valdez. If we had rescued his boat and built it and made it bigger than ever, and then put him in charge again, we don't have, as you say, we continue to have insufficient oversight. And before we get to the captains of Wall Street, and I do want to get to the captains of Wall Street, but I do want to focus for a second on the ratings agencies. I think you guys, in fact, I know the FCIC, your commission, concluded that the failures of the credit ratings agencies, so-called, were essential cogs in the wheel of financial destruction. So, these are they're called agencies, which gives them a kind of quasi-governmental aura. We're talking about Standard & Poor's and Moody's and so on. But they are, in fact, privately traded companies. They're for-profit. And has there been any? They misled, I would argue, the public and investors a great deal in what they described as AAA. That contributed a lot to the trouble. Correct me if you think I'm wrong. But has there been any significant change there?
Changes at the fringes, more transparency, greater requirements for training and expertise, but the essential system remains unchanged, and the essential system still has the fundamental flaw, the fundamental conflict that it's the issuer, Goldman Sachs, J.P. Morgan, Bank of America, who pay the rating agencies for the ratings, and as long as that conflict is there, we're in a sense, setting ourselves up for trouble. The SEC had some choices here in the way to go, and I think they should have taken a much more strong and robust swing at reform. For example, Senator Al Franken had proposed to break this conflict of interest by having an independent entity select the rating agency that would give the ratings and not have that be based on who was paying the bill. So that fundamental conflict still exists today.
Well, I had, just so you know, I had an even more radical proposal. I liked the Franken proposal, but I felt that perhaps we shouldn't have rating agencies be for profit at all, that maybe they should be some sort of...
Well, I think there's a number of ways you could go that would be fundamental departures from a flawed system. What we saw in the crisis was you had essentially a duopoly of Standard & Poor's and Moody's. Even though Fitch gives ratings, you had these two entities that controlled the market. You had the conflict of interest. We saw that profit motive overwhelmed ratings integrity, that Moody's and Standard & Poor's were more interested in driving up their profit than providing the resources to their companies to do high-quality ratings. So there's a number of ways you could substantially reform the system. One is the Franken proposal. One is to move to nonprofit entities. The other is for major shareholders, investors, the big pension funds in this country, to essentially support the rating agencies because it is for the benefit of investors that ratings are given. So,
right now we have, that's a great point. And again, we're talking with Phil Angelides, chairman of the Financial Crisis Inquiry Commission, which delivered its report some years ago. I think that's an excellent point, of course, because right now they're paid by the banks and other entities that they're rating, which is a built-in conflict of interest. So if they were being paid by the people who use those ratings to make decisions, that would also be a significant improvement. Now, I said I wanted to get back to the captains of Wall Street a little bit, and I do. Two things strike me about the data that your commission uncovered and what we've learned in other ways since the crisis of 2008. One is the epidemic of fraud, and the other is, which is why I use the Exxon Valdez example, the incompetence, the fact that they did, essentially, they would have destroyed their businesses had they not been rescued, and yet many of the same people stayed in place. There were no consequences for either the incompetence or the moral issues. And recently, your commission was back in the news because the National Archive released a number of the papers that had not been made public. And by the way, feel free at any point to tell me you just can't comment on certain things. But among other things, it talked, some of the information that came out was about Citigroup and Robert Rubin and the former Treasury Secretary and former head of Citigroup, and the fact that in the Citigroup case, as well as perhaps in others, referrals had been made to the Justice Department for criminal investigation. Were you surprised? As far as we know, there was no investigation. We certainly know there were no indictments. Were you surprised at the lack of follow-up in these referrals?
So let me just make one general comment. You said something that's important. Very little consequence for Wall Street and for the senior executives who nearly led our country's economy over the cliff. And by the way, forget legal consequences for a minute. Compensation on Wall Street was back up to record highs by 2010, and it's a rare instance that you can find a senior executive that suffered any consequence, loss of bonus, loss of pay, loss of position for the incompetence or misconduct that led to this crisis. So on the matter of referrals, let me just make a couple of things clear. Our main task as a commission was to examine the causes of the crisis. We were not set up as a prosecutor. We weren't set up as judge and jury. And because of the broad kind of mandate that we had to look at the crisis as a whole, we weren't set up to look at individual cases of misconduct. But Congress was very clear. And Congress said to us that if we found potential violations of law, we were to refer those to the Attorney General of the United States. Now, we've always made it known that we made referrals, but it was only in the last few weeks when the National Archives began to release records that what became public is what our commission did in fact send over to the Department of Justice. And we sent a number of matters. And just for one clarification, they weren't recommendations for prosecution, and they weren't necessarily recommendations for criminal action. They were a referral in which we expected the Department of Justice to undertake the full investigation that we as a commission were not equipped to do. And what I can tell you here 5 years out from the time that we did that is I've been disappointed that there hasn't been the pursuit of individual misconduct at major financial institutions by senior executives. Now, there should be no prejudgment of guilt, and there should be no pursuit of what I'd call vengeance justice. But I will point this out. Since the crisis, the Department of Justice has brought criminal charges against 2,700 individuals at the local level, people who, mortgage brokers, borrowers who may have engaged in mortgage fraud at a relatively small level, 5 and 10 loans. And while the Department of Justice has zealously prosecuted the person who lied about 5 loans or 10 loans, there's been no prosecution of the people who lied about millions of loans. Let me just give you one example of a place where we made a referral to the Department of Justice, and we uncovered very damning information. It's the very information that led to over $40 billion in fines against 19 major financial institutions. What our commission found was that major financial institutions, whether it was J.P. Morgan, whether it was Bank of America, whether it was Goldman Sachs, when they were buying loans from Countrywide and AmeriQuest and New Century, and they were bundling up those loans and selling them as mortgage securities, they undertook due diligence on those loans. And we uncovered records that in 2006 and 2007, a firm called Clayton examined over 900,000 mortgage loans for those major financial institutions. And they found an enormous number of defects. Nearly 1 in 3 loans was defective. The banks knew this information, but despite knowing this information, they packaged these loans as securities, they sold them to investors around the world, and they made material misrepresentations about the quality of those loans. In our report, we said it raised serious questions of violations of U.S. securities laws, and this is one of the matters we referred to the Department of Justice for further investigation. Now, based on this evidence, the Department of Justice has obtained more than $40 billion in settlements and fines, yet not one individual has ever been named. So apparently here we have material misrepresentation. We found potential mortgage securities fraud by major financial institutions, but apparently while banks were involved, no bankers were involved. And I think that this is very troublesome because there really needs to be a focus on individual accountability, not going after inanimate corporate objects where fines are paid by the corporate shareholders, and the senior executives who either condone this behavior or approve this behavior are never subject to investigation. Now, if in fact the Department of Justice did a full investigation, they owe it to the American people to lay this out. Because absent that, I think it breeds a lot of cynicism about the fairness of our judicial system.
Well, I think that's exactly right. And you said one thing I want to re-emphasize, which is you said this is not about personal vengeance, but there is the principle of deterrence that says if you are not punished for committing a crime, if in fact you're enriched for committing a crime and there are no consequences, and you're in a position of power or authority, you're highly likely to commit that crime once again with the same consequences for the economy or the world as it had once before. So, Phil Angelides...
Well, Richard, let me comment on that for a minute.
Sure.
I mean, let's just take something that we could all relate to. You know, if someone knocked over a convenience convenience store for $1,000, and they could settle it up a few months later for $100 and no admission of wrongdoing. Would they do it again? They might well. And in this instance, what we have now is 19 major financial institutions having paid over $40 billion in fines. Clearly, these banks engaged in misconduct, but apparently no banker involved. And you're right, this sends a terrible message about deterrence, and it sends a terrible message about the fairness of our judicial system. So my view is that, and now I might add, the Department of Justice in September of 2015, in a sense, recognized this flawed approach and said from now on, they are going to pursue individual misconduct. And by the way, that, it may not be criminal, but there were no civil charges really brought in these matters. There was no executive that had to disgorge bonuses.
So no consequences. Yes, go ahead. We have about 60 seconds left. Yeah.
60 seconds. That I've urged the Attorney General to refresh this investigation because the statute of limitations has not run.
That was the last point I wanted to make, that you have recently pointed that out, that for these types of crimes, they are still prosecutable. I certainly hope some action is taken and that we don't have to believe that our government, having defined victimless crimes in our sociology, now believes in criminalless crimes. Somebody did something for there to be so many billions of dollars paid in fines. But Phil Angelides, former treasurer of the state of California, businessman, former chair of the Financial Crisis Inquiry Commission, thanks so much for joining us.
Thank you very much for having me.